Hello, how are you, YouTubers? Today I'm going to do the another stocks, and this is not a this is a FANG stock, one of the most popular stocks under the FANG groups. And if you heard this name a lot in FANG is Facebook and Amazon, right? Alphabet, and the N's stand for that there is Netflix. Okay, so Netflix is, if you have invested in Netflix, I can give you the power of this stock is how much it has as growth power. In 15 years ago, you have made your investment. Can you make a guess? Let's say if you can make a guess. Uh, I'll give you a minute, or you can pause it, right? And think if you can match it. It's not 5 times or 100 times, not even 200 times. It's little over 400 times of your investment. So that's the power of the Netflix. So today I'll suggest you to watch this video until the end. Not only the reason I just want to tell you how uh, it's rollout, right? So I'll keep the suspense and like you to take this journey with me. All right, this is one of the famous stocks. If you open any of the financial channel, you heard this stocks FANG, right? That's it. And N is Netflix. So if you're new to the channel, I just give my introduction. Myself, Pramod Kumar. I'm a CFA charter holder and FRM certified. I also have my blog, which is Rise Analytics. Mostly there is some contents, but most in my channel, I try to take some stocks and then put my opinion on it, and just for the entertainment and education purpose at the same time, and nothing beyond that. Sometime I also take the list. Basically, my list is growing because I get a lot of comments on a personal phone or on the YouTube comments. So if you like it, please subscribe to my channel and like it, share it. This is the only way I can grow, and more people will aware of it. So without any further delay, let's start with it. Okay, so here you go. So if you have missed the 15-year rally, 10-year stock growth is not that bad. It's 57 times, 0.21 times. If you have missed the 10 years ago as well, 5-year rally was not bad as well. It's 8 times of our investment, right? So that's the power of this. I want from my YouTuber, right? So this time, so who are watching this, I don't want you to go and eventually jump and then say, please watch this carefully, the whole session. And also, whoever owns this Netflix stocks, do you mind put in the comments? And if you don't own the stocks, which other streaming company you own, right? Do you own any digital company, streaming company, or any entertainment business, right? Because average entertainment, the index does almost 11% in 15 years. So that's what I find while doing the research on this stock, because this comes under the entertainments. The another company which stands out is the Disney, right? So Disney is also starting doing the streaming and also is in entertainment, and then few other companies are in. But if I say on the more large cap, is this company is worth $188 billion, right? So that's a lot of money if you want to buy that company. Okay, so let's get started. So I think this is a very good motivation to start, and I'm also very interested on this presentation, honestly. So just want to give some highlight agenda. We'll go on the returns, not only just the price return, but now from the financial books perspective, right? That's I showed on the price, how the price, if you bought it, how the price reflect. So return on equity, assets, and investment cap and IOC, and then revenue growth, earning growth, and then we deep down into the financial. That's mostly the trend. And depend upon the company, I pick different aspect or the industry, right? Depend how the data flow, and that's how, and then I'll form my opinion. Okay, so let's go quickly. Okay, if you see the return on the equity from 2015 15, this is the per year growth. So that's an immense growth as well. So if you see from it's 16, it's 7.61%, then it straight jumps to the 17.85% to 27 and 30% return on equity, right? That's a per year, I'm telling you. Return on investment capital, depend upon how the capital you have invested, it's 12%. This is on the annualized basis. I also did the quarterly revenue. So because most of the people due to the coronavirus at this time, it's at home. So the company makes some money. So not that any problem from that kind of a perspective. So I want to see from the smooth perspective, right? When even if everything is over or not over, how the company, the model is doing, how the company is doing the business, right? So that's what is the more focus here. Okay, so the return on assets, they can able to generate the return based on whatever the assets they have is 6%, and this is also keep growing. If you see from, it was only 1.42% in 2015, and this is 6.2%. Okay, so that's not very outstanding as compared if you see from the return on equity. I expect these two numbers to jump up as well, but we'll see in future slide how it will come. Revenue growth year by year, this is amazing, right? This is 23 to 30. That's what we see on those financial channel, those hosts. They always say, oh, this revenue goes this times, many times, and so on. Okay, so let me tell you what's the profile of the company as well before I go to the deep further. So here I am on the financial of the company. I have already downloaded, so it's easy for me to actually highlight and color code. I won't able to do that. This is the 2019 year end, the 10K. Let me show it to you, this one. And then if I see this, will say, okay, this is a streaming company, and they have at that time 167 million paid members, right, in 190 countries. So that's very diverse, right? If you see, and they are all into all TV series, documentary, they make feature films as well, and so they are in multiplace. They're not just they're doing the streaming, but they are in different segments of the market as well. Okay, so that's their business. So and their geographic wise, they're pretty goes as well. We'll look, but I want to look into the more detail as well. I just want to tell you that how is there. It's not like in one country or few countries or globally. It's in many countries and in different section as well. Okay, so I have used their Netflix service as well from the service point of view, and it's not that bad, right? It's okay. Okay, but now I'm not using Netflix, just to be tell you that. Okay, let's go next. I think this one, yeah. So this one, I hope it was not highlighted. So this is 2015 and 2019, and this is the pretty good. Okay, let's go next. Revenue, I already have highlighted. Okay, now let's say they're earning per share. So basically, if you buy a share, how much earning growth it's going from year to year. So earning is jumps. If you see from, this is 2015 to 2019, it was negative before, but then it jumps suddenly to almost 100% because it was negative 50 plus 50, and then it jumps again to almost 193%, and then drops, and then it's dropping 116 to 53%. Now the question is, okay, what's happening, right? The revenue looks very good, but why the earning is not very stable, and it's also going down? Okay, so that's the problem. So let's see next the price over. So basically the price over book or a PE ratio is way expensive. If you see, in 2015 is 400 times to now latest this year it's 85 times, but their PE is almost always like 22, but as per their book value, it's very expensive, but the based on the earning is 2022, which is pretty normal, I believe, in case of this is the growth stock. So I won't pay much attention to that. Okay, so this is I think the starting of the core or the heart of the section. So when I see this, I say, whoa, wow, what's happening here, right? What's happening, honestly? Look, what is this data showing me? This data showing me, this is the revenue, and I compare with the bottom line. So top and bottom. I like this chart. It gives me a lot of information in one shot. Look at the revenue, right? The revenue is increasing the spike. So that's what maybe they tell, oh, I increase 5 times from 5,000 or 5 billion to 25 billion, right? In terms of the revenue. Oh, wow, Netflix did 5 times. This is the news. But look at the bottom line. This is garbage, right? I hardly see it's there, right? We cannot even see this. That's like a slice in 2015. Same thing in 16. 17 is a little bit come up, and 19 is a little bit up, but not even close to 5 billion, right? So what's happening here, which makes me shocked? The company stock who is doing so well in terms of the price, is it, now the question is come to my mind is it just the marketing, is just the news, fame? Okay, is company, the revenue is growing, but why not it's supporting the bottom line, right? So as an investor, if I want to invest my hard-earned money, I want this orange to go up, right? And the gap between lower and lower, right? I don't want to be 100% for sure. It's not possible, but at least it should be 20-30%, right? It's here, not like is way low. Okay, so let's say let's revolve. Okay, when I see the margin, now it's give me some few area. Okay, so this is the 3 broad. I try to summarize the content in a very layman manner, right? So it's easy for everybody to understand. So this is the percentage, and again this is a 5-year trend. You notice this is a gross profit margin is 38%, right? It's going 30 to 33%. But look at there in the operating margin, right? This is the EBITDA margin, way low. My God, look at the difference. So 5% to 30%, right? So almost, if on the absolute terms, is like 25-26% higher. Look at how much is just chunk. I never see like this when analyze any kind of I did like a Facebook stock, and even the consumer Apple, right? Which is the FANG group, right? As well. I think Apple is also the FANG group as well, or Amazon, right? Amazon, I haven't did it, but those I did it. And some other company like Nike as well, I did it. I haven't seen such a gap in terms of expenses. So what the hell is going on here, right? This is, I really don't like it, because their margin, look at the margin in terms of net profit, right? Is only 1.8% in 2015. And now it's only 13%, the net profit, right? So this means the major of the problem chunk goes to the operating expenses. Okay, we'll look into the more detail there. And to make the things even further worse, you can see from here, right? This is one of also my favorite chart when I put it here. Look at the net income. So the net income here, it says, okay, it's growing. Now it's growing to little shy over 2 billion, right? Look at here, 2 billion. When their revenue is 25 billion. You see, this is 2 billion, right? It shows here 2 billion. But how much from their income they are converting into cash, right? That's a valid question. This is negative. You see, this is negative. So from 2015, this was keep increasing from the negative term. So look at here. So in 2015, it's little less over 1 billion. And then up to now, it's little shy over 3 billion in terms of their core business, the cash. I don't care on any other, how they generate. I care if you're doing the business, right? And you're getting the revenue, at the end of the day, if you don't get anything in your pocket, right? I don't matter how much the price tag you put it. Let's be straight. So sorry if somebody is this is just reflecting my opinion based on the data. I don't want to hurt anybody feeling, but that's just what is showing it. If you own that, this is a growth stocks price, that's okay. But so far, I'm just presenting the fact, and my this channel I'm trying to present the fact and I don't care whether this is N for Netflix or N for any other name, right? So this is the Netflix data, and this is what it's presenting, and it makes me now further curious what's this happening underneath the water, right? So, and which is not good at all. I haven't seen, so that's why I make a precaution to you that don't go and jump there when you see there. Okay, let's go further. Maybe this is we'll find something more. Okay, so now from there I want to go to their 10K and show you something more. Okay, so let's see back. So here we are seeing their financial statement, the 10K statements, and now we'll try to find why the gap is. So the cost of the revenue, you see, is immensely over, right? So 69% or 62%. So that's major chunk is going there. So this means their cost is very high. So the cost is amortizations of streaming content assets, expenses, acquisition, licensing. So in the payroll and all those stuff, right? The marketing cost in terms of their sale is they're spending a lot in terms of marketing, which is seen here 13%, right? To keep up with the revenue. Technology wise, they are also depend upon Amazon, and they're using Amazon services. I have read here, and this is also they're doing some technology development and related expenses, right? So this is 8%. This is another expense. Their general payroll, that's not bad. So the main thing is, so what the problem I think what they have is the content which they're trying to stream. The cost of that content is very expensive, although they're generating the revenue and all, but the cost is very high. But now the thing is how they are surviving, right? If they have this much problem, how they're surviving, how they are surviving, that's my question. I don't want to look. Okay, now look at here. So the long-term debt is $14 billion in 2019 and $10 billion in 2018, which increased, right? Their cash in the balance sheets, it shows 3 billion to 5 billion. Now from where this cash is coming, look at here. The cash and the cash equivalent, or the cash is increased, which is increased $1.2 billion in 31, right? So it's increased, they're saying, due to the issuance of debt. Oh my God. So they're raising more and more debt. And what they're saying, even they're raising, but it's partially offset by their use of the cash flow operations. So basically what they're doing, they are raising the debt, and then they are paying it up. So basically seems like based on their revenue, or maybe they're diluting their equity, they're doing that. The free to cash, look at here. So that's what's happening here. So 3 billion, 4 billion and 4.5 billion. So they consistently doing that. Okay. So that's now then this is, I just want to show here their contractual obligation, right? In terms of streaming and other debt. This debt detail I will show you later. But look at there, right? What's their payment period? In total, let's say within 1 year, right? Which should be this 2020, right? Because this is published in 20. So this is $10 billion in terms of 8 billion in terms of streaming. Look at how much costly is it, right? And then on the debt doesn't look that much, but look at continues, right? 1 to 3 is 2.5 billion. So the debt is also increasing. And after 5 years, look at this $15.69 billion in terms of debt, right? So if I show you their latest This is the latest as of the 31st March 2020, right? Now I'll show you their debt details. So what they're happening since 2013, every 1 or 2 years, they're issuing the debt, which is right, which was not matured before, so they can get that growth. But now it start maturing from next year, right? And I'll should see the price drop of Netflix because of this, right? Because they have that happy path of 5 year. They can say, okay, my revenues grow 5 times, 4 times, but starting from next year, it should start declining. Let's say 500 million, 700 and all. And let's see in terms of the debt as well, right? So as of, this is latest as of March. So it's 1.12 billion for this year. Within 3 years is 2 billion and 2.5 billion, right? So how they going, if their cash is negative? Now my question is, if their cash is negative, okay, if their cash is negative, how they going to pay? That's the question. Maybe they issue more stocks, right? Dilute the liquidity, or I don't think so. If they can do, or they have to issue more debts. If they issue more debts based on their revenue, the first question, maybe the debt holder will say okay, or if they want to pay more debt, they can have a high cost on the debt as well. So although the company has a happy path, but I don't own Netflix. I missed those rally, but looking at this, I don't think so I have that much guts to take part in that speculation that it may continue in future as well, because past performance is not a guarantee for future, but it can be if the at least for some aspect, if the business is strong, if the fundamental is strong, which in this case, as you can see, at least I haven't find that, right? So from the perspective of the from the perspective of the rational investor, right, where I want for sure the return is high, but I want to see what's under the water and then make for the long term perspective. So maybe they get away for few years, right, and have the continued rally on the price. But I also see competitions from the other side as well, like Disney and so many other streaming companies are the Amazon, right? Amazon is also enter into this market. When Amazon enter into the market, I don't own Netflix, and honestly, I don't personally own Amazon as well. So that's I'm paying. I'm saying that. So I'm making an independent, but we do see that whenever Amazon enter in any of the market, it disrupted, right? So let me know what's your opinion on this one. If you like it and you like me to show your appreciation, so kindly subscribe and like this video. If you like this video, Google algorithm saying this content is good, and then they promote more and more to the other, and more people will able to see. And my target is to soon hopefully get the 1,000 subscriber, and please forward this to your friends, families, so all will get the benefit of it. This is simply my opinion. You know your own portfolio, see take advice from your financial advisor, and if you like any other stock which you want me to cover, so kindly put in the comment box, right? And I'll try to cover that, and see you in next video. Thanks for watching. Bye for now.